I went to a conference in Dallas, and that was like my first real introduction to syndication, and I decided at that point that I was going to try to passively invest. The aha moment was really when I see my first distribution check. And I think at that point is when my mindset kind of switched, and I decided that I can do this. Like, I want to do this.
Welcome to Spur Equity's Spur Your Wealth podcast, your ultimate guide to passive income through real estate investing. Join us as we together discover the secrets of building wealth, one passive investment at a time.
From expert insights to inspiring success stories, this podcast will inspire you and empower you to take control of your family's financial future so you can live life on your own terms.
Hi, everyone, and welcome to another episode of Spur Equity's Spur Your Wealth podcast. I'm your host today, Budham Singh from Spur Equity. So as you know, on the Spur Your Wealth podcast, we aim to bring successful investors and experts on our podcast to share their story and secrets in investing so we can all stand to benefit from their experience. And so on today's episode, we're really excited. We have Tim Little. Tim is the founder and CEO of ZANA Investments. It's a Tampa-based real estate investment firm focused on multifamily assets. He's passionate about helping fellow military veterans escape the landlord trap, as he says, and get competitive returns by providing opportunities to invest passively in apartment buildings. Tim started investing in real estate with a single duplex in 2014, and now he's grown his portfolio to 693 co-owned units valued at over $90 million. Really incredible journey there. So if you're looking to get started with real estate investments, his story will truly inspire you. Welcome, Tim. So happy to have you on Spur Your Wealth podcast. Really looking forward to the conversation today.
Yeah, Param, thanks for having me. I'm really excited to be here.
Excellent. Well, let's dive right in. So, starting with a single duplex in 2014 and growing to 693, that's an incredible journey. So, why don't you give our listeners a little bit about yourself, a little bit about your background before real estate, and then what led to that first endeavor, and then how you grew from there?
Sure. So my background is mostly military. Went into basic training for the Army a month after graduating high school. So, fresh 18 years old. Got to see some of the world and was like, that was fun, but this isn't for me. So then started going to school, a little bit older than everybody else, but that was okay. Went to Florida State for an international affairs degree. And at some point, the ROTC recruiter got to me and he's like, hey, think you might have something to offer, having been, enlisted yourself, starting out at the bottom. Have you thought about becoming an officer? And I hadn't at the time, but, he made a lot of good points, and there was also a guaranteed job at graduation. So that sweetened the deal, certainly. And so I decided to go into the ROTC program. And when I graduated from Florida State, I went back into the Army, this time as an officer, and did that for about little over 5 years. So, a couple of combat deployments later, decided I was going to go ahead and take a knee and wanted to head back to school. So that's when I went to grad school at University of Denver, where I met my beautiful wife. And after that, was set on this path of, what most people expect, right? You go to school, you find a good job, you work it for however many years, and then hopefully retire one day before you're not quite too old to enjoy it. And so I wound up getting a job at a government contractor, was doing that for a little while, but again, just a little dissatisfied and a little bored. But the way that real estate came into the picture is it like little sparks along that way, right? So I first, started looking into real estate way back, I'd say in like 2005 when I was still in the Army as an officer. And Rich Dad, Poor Dad, was my entree, like for so many people. And I wound up going to one of these, conferences that was local. And at the time, this, again, like right before, the bust, and it was a lot about single family homes, driving for dollars, getting little old ladies to sell you their house because their husband just passed away. That kind of like slimy kind of real estate stuff that was going on at that time. But I still understood the basic concepts that, real estate can help you build wealth over time. But what I found is I just wasn't in the right place at the right time, right, in my life. I was still I was about to go on another deployment. And then, after that, I was in grad school, and I'm like, oh, I'm in grad school. I'm a student. I don't have any money. You could argue those limiting beliefs, right? I could have found a way to make it happen, but didn't even enter my mind at that point. And so it wasn't till I was in a, relatively comfortable job that I was like, okay, now I can look at starting to invest and build wealth and all that stuff that, you should always start sooner rather than later. But, later is better than never, I suppose. And so I committed myself to just taking action at a certain point after, having read a couple of books. But I was focused, like most people, on the single family. But then I discovered small multifamily and was like, hey, that's an easy way to kind of mitigate the risk, right? So even if you have a duplex, if it's only 50% occupied, you at least still have money coming in. Whereas if you have a single family house, it's either 100% occupied or 100% vacant. There is no in between. And so I really liked that idea of at least starting off with a small multi if I could afford it. Now, I was living in Washington, D.C. at the time, and I certainly couldn't afford to buy a duplex, let alone a triplex there. So started looking out and looked at Richmond, Virginia, because it was a much more affordable area, still within, a couple of hours driving distance. So certainly not close enough to self-manage, but close enough that I felt comfortable that I could go and visit the property on a weekend if I needed to. And so my wife and I just made a weekend out of it, went and visited 5 or 6 different duplexes in Richmond with a great realtor down there, and wound up putting an offer in on one of those duplexes for $85,000. It was accepted, and that was really the start of the journey.
That's great. What year was that?
That was in 2014.
That was 2014. Wow, that's great. Yeah, and even Richmond. I mean, I don't know. Do you still own that property?
Oh no, I wound up selling that property, I think in 2017, or yeah, I think it was like late 2017, and even then the value had gone up pretty good. I wound up selling it for $150 without a contingency for inspection, which has its own value in and of itself, right? Because it was like 100-year-old house that was basically just divided between the top floor and the bottom floor because they just sealed up the stairwell. So anything that old, they're going to find something. So when I got that offer, I was just like, hey, sounds good to me.
Yeah, that's great. So you bought it for 80, 85, sold it for 150. And so obviously you had, what kind of lending options were available to you at the time? I'm sure you leveraged, right?
Yeah. So we just got a regular loan on it. Because it was an investment property, I did have to put 25% down, which, just it shows my naivete, right? Like I didn't even know that when I was doing it. I thought I was going to be able to put 20% down and, that would be good enough. But again, because it was an investment property, the banks required 25% down. It hurt a little bit at the time. I had to put like 23,000 down, I think. And at the time, that was a lot of money for me, capital, but was able to make that happen. And so it was a pretty traditional loan. There was just the requirement of the 25% down.
So how did you manage that? So you're like a couple hours away, right, from Richmond. So did you have a property manager, or did you just kind of go on weekends and kind of manage that? I just want to understand either the partnership component, right? And there's a cost associated to that, or the time component that you had to actually spend on that, small property. Talk us through that.
Certainly, and I've done both. On this one, I decided to do the partnering. I wound up using the property manager that I basically inherited with the property, and as well as the tenant that I inherited. Both were problems. The tenant paid for maybe a couple of months, maybe 2 months, and then just stopped paying. And before we could even take any, like legal action or anything like that, they just popped and left in the middle of the night. They skipped and left all their stuff in there. So, that was the first time I was kind of exposed to some of the costs associated that I hadn't really thought about, right? Oh, well, you would think, oh, that's great. A non-paying tenant moved. Well, now you can get someone in there to start paying. Well, yeah, but before that, I had to pay a few $1,000s for someone to move all their stuff out, and then a couple more thousand for the unit turn to get it rent ready, so that someone else could be in there. So that was my first headache, right?
Yeah, and then depending on where you are, just the legalities of what you can do with the stuff that they left behind. It changes, right, from municipality to municipality. So having to deal with those sort of legal hurdles as well, if you're not familiar. Okay, so talk us through. So that was the first property, and you did quite well. I mean, if you're talking about selling it in 3 years, you had a loan on it, you sold it for 150. I mean, you more than double, triple. I don't know how much you cash flowed, but you did pretty well. If we're talking about return numbers and percentages, you did quite well, but you had to do a lot of that yourself, right? Like you had to put some money in on the turns, like you said. You had a property manager. There was additional cost, but you managed to do pretty well on that one. So talk us through from that to where you are today. What did that journey look like, getting it to 693 units, and what did you do differently each time, right? Acquiring new properties and changing your approach.
Sure. And so, yeah, I mean, you bring up a good point about the cost associated, right? If you have a property manager, you're going to pay for it so that you can get your time back. And at that level, at the very small properties, you're usually paying about 10% of the 10% of the total rents collected. So that's a pretty big chunk. So that's why it's a little more challenging to get the kind of cash flow that you may be shooting for on those smaller properties. I think my goal at the time was $200 a month per unit per month cash flow. And it looks easy on paper, but you add in again insurance, property management, one-off costs like having to move out the tenant's crap, or something that breaks down like a water heater. All of a sudden, you're seeing your profit just disappear, just incrementally. So that's one of the challenges with the whole owning the small multis and even single families. After that, what I did is I did a 1031 exchange from that duplex into a triplex here in the St. Pete area, or the Tampa Bay area where I live, specifically in St. Pete. And that was so that I could get more economies of scale going from a duplex to a triplex, right? And it was a little bit nicer of a property. It cash flowed better. And then the advantage for your audience of doing a 1031 exchange is that you defer the taxes that you would have had to pay on the sale of that property, right? So that all the cash that I got from that property, I never touched it. It went directly to the down payment for that triplex in St. Pete. So the other advantage there is that you're not coming out of pocket for capital, which can be huge, right? Because I was going from a property that had originally cost me $85,000, and I had a down payment of like $23,000, to a property that was like $360,000, which the down payment obviously would have been closer to like $70,000. But none of that came out of my pocket because I used the proceeds from the first sale to go into the purchase of the second.
Right. No, that's really powerful. I mean, we've done the same thing, and we went from smaller to and a 1031 is so powerful, right? Because especially if you don't need to, like, I mean, we were in the same situation you were, right? That we were using our own money at the time. And so we weren't beholden to investors. So we weren't paying out anything. And so when we 1031, we're like, all right, what's the biggest property, that we can take down without injecting more capital into it, right? So all the proceeds that we made, we went from 16 units to a 52 unit property, right? And so, yeah, there's so much power in that versus cashing out and then having to redeploy, because guess what? 20-30% of that is gone now because it's the government's taken it. So if you can use it, defer those taxes, do a 1031. If you're purchasing on your own, that's very, very powerful to grow.
Yep. And so after that, this was around the same time that I discovered syndication, right? And passive investing in commercial multifamily. So really started to dive into that, books, podcasts, all the things, and, going to conferences. And I went to a conference in, I think it was Dallas. And that was like my first real introduction to syndication. And it was kind of like drinking from a fire hose. It was just so much information and so much that I wasn't familiar with. But I learned a ton in that weekend. And I decided at that point that I was going to try to passively invest in a deal, because of course they tried to pitch me their $25,000 course and coaching and this and that, but again, that wasn't the right time and place for me to do that, because I wouldn't be able to take advantage of it. I knew I was about to go on another deployment and be gone for like a year, so I wouldn't have the time required to take advantage of that coaching. So I was like, I think the next best option for me was to try to passively invest in a deal, use that money so that I can like earn while I learn, right? I hopefully will be, getting nice returns from this investment. But at the same time, because I'm an investor now, I have the opportunity to ask questions of that sponsor, the person who put the deal together. And so I'm learning what it's like from the investor perspective and just learning the business overall. And sure, I asked a lot of stupid questions, but that's okay. I was, I was basically paying for the right to do that. And so I got in on a deal and I invested as little as I could because that's how much I had. I had like 25,000 that I could invest and not worry about, right, for like 5 years. And so I found a sponsor who was willing to take that low, which is, relatively unusual. And because they were early on in their career as well. And it wound up being a great deal. But the aha moment was really when, I'm sitting in Baghdad and I see my first distribution check. And even though it was only like, say, I don't know, $200 or $300, right? It didn't matter. It was that proof of concept that I needed to know that it was real. And I kind of like wiped my brow like, whew, okay, this wasn't a scam. I won't be on the next episode of American Greed. This is a real thing. And I think at that point is when my mindset kind of switched and I decided that I can do this. Like, I want to do this. So that was where that inflection point was.
That's great. I mean, and I think, again, our journey was very similar in that, like, every conference I went to when we learned about syndication, drinking from a fire hose, that's exactly right. Like, I came out with like 15 pages of notes, right? Like, that I had to like go through after the fact and kind of align our business, even though we were doing, our own projects and our own, we had our 50 unit property at the time. But the learnings that you get from that, just from a business plan perspective on, how to improve NOI, all these different additive, kind of value things that you could do to your property, right? We started implementing that right away, even though we weren't syndicating that one. And so there's so much value to get out of those kind of conferences. Secondly, I think what you mentioned was really important. And I think that's the guidance that we give our investors as well, that, we have plenty of investors that are, let's say, active, busy professionals or physicians or business owners. They know they want to be investing in real estate. They don't have the time to spend. So, passive investing is definitely right for them, right? And so they invest passively. But secondly, there are folks that are like, hey, I want to actually learn so I can do this myself. And we're happy to take those guys on because same, in our industry, you're not, all of us, we're doing the same thing. We're not necessarily competitors. We're actually potential collaborators, right? We can collaborate and do things together, do bigger things together. And so when investors approach us and say, hey, I want to do what you're doing, we're like, let's do it. Let's do it together. But I think what you did, that's kind of the guidance that we give our newer investors is, hey, invest passively in a deal, right? Because you're earning at the same time as you're learning. So you have access to sponsors, you have access to the underwriting, you have access to the business plan, you have access to the financial reports. And so you get to learn exactly what is being done to this property to make it better, right? To increase the NOI, to do the operations, to work with property management, work with lenders, all of that, and then ultimately sell the property. So you're going to be along that journey along the way. And guess what? You're going to be making money. So the same, I'm a big fan of masterminds as well, but at the same time, dishing out $25,000, $30,000 for a mastermind for somebody new can be quite a lot. And so what you did is you had $25,000 to spend on, let's say, a coaching session versus investing $25,000 in a sponsor that you feel really comfortable and confident in. You actually did that and turned that $25,000 potentially into $40,000 or $50,000. And you learned the whole process along the way. So there's a lot of, financial value that you got, but also educational value that you got from that same experience. So that's the same kind of guidance that I give to folks that want to be active is, hey, invest in a deal passively that you believe in, with a sponsor that you believe in, that can take you under their wing and kind of show you the ropes, and you'll learn a lot more, a lot quicker when your money's kind of tied to the financial success of the entire project as well.
Yeah, and I think the other aspect that really isn't talked enough about is the empathy, right? The perspective that's gained by being a passive investor first. You really start to understand, the questions, concerns, and perspective of those passive investors, so that you're better able to empathize and answer their questions and hopefully, predict what their concerns might be once you're that sponsor.
Yeah, I think that's absolutely right. I mean, we're passive investors in deals as well, and we learn things like communication, right? Like, what communication am I expecting as a passive investor? What cadence of communication? What's the right level of detail that I want? Because too much can also be overwhelming, right? So it's got to be a right balance of not enough information and too much information. So you got to be right in the middle, from an investor standpoint. So I get that exactly. So put yourself in the mind of the investor. Once you're a sponsor, then you're able to actually communicate and relay that information a lot more clearer.
Yeah, and just in terms of where it went after that, it was really once I wound up going to another conference, right? And you meet a lot of great folks there, and some people that you think you might be able to partner up with. And so that's basically how I got on my first deal, which was actually here in Tampa. It was a 59-unit portfolio deal. So a little messy from the perspective of not being a single property. But I think the largest of them was like 23 units, and some of the other ones were like quads and duplexes, but they were all within like 1 mile of each other. So it wasn't too bad from a management perspective. And so, I met a bunch of great folks coming out of, convention. They came to me and were, asking if I wanted to be a passive investor in their deal. And I was like, that sounds great, but not right now. I was like, I had some capital set aside, but I was also just as hyped up as they were about, doing my first deal, and I need to have capital to put into that deal. So I was like, let's go, So why would I want to be a passive investor on someone else's deal? Because I wanted to make sure that I had capital ready to put into my own. And so they came back to me, a couple, I don't know if it was weeks or a month later, when they're getting closer to closing on that deal, and they still weren't quite at the line, right? Like, they still didn't have enough to close. And so they came back to me and said, hey, Tim, would you be interested coming on as a GP, right? Like I'm in Tampa, I'm boots on the ground. I can help out with a lot of different aspects of the deal, as well as bringing my capital to bear on the deal itself. And so that's how I was able to basically, sneak into my first deal as a GP. And that's where once you do that first deal, you find out, who you like working with, who you don't necessarily, how you like to run deals. And so some of the partners that I worked with on that deal have been the partners that I've worked with on every deal that I've done moving forward.
That's excellent. That's excellent. So, yeah, I mean, and that speaks to the power of partnerships, right? To be able to, find people with that align values, that have certain expertise that you can actually leverage. Some things that, we bring to the table. Let's say you bring to the table some certain strengths, and other people bring certain strengths, and they complement each other. I think that's the beauty of partnerships, that we don't always have to be the best at everything that needs to happen on a deal, but we can have certain strengths and then marry those strengths with other people. And I think a lot of folks in our industry have been successful because of those partnerships, that they can, partnerships can actually fill the gaps, right? Where maybe all of us don't. Like I'll say, for example, on my side, property management, that I've done that before. We've done that on our properties. I quickly found out that's something that I do not excel in, that I do not want to do. So I will 100%, find somebody that's excelling at property management, asset management, some of these other aspects that, hey, they're better at it than I am. So let's partner up and do these things together. So again, I think with partnerships, you're allowed, it enables you to do bigger and better things, right? So, because you don't have to be everything to everybody on one deal.
Yeah, and I think that's the mind shift that needs to take place for a lot of people who are coming from the single family realm. And for some of them, it's hard because they're so used to being in charge of everything and doing everything themselves that they don't understand that, when you come to the commercial multifamily side, the larger side, there isn't just, one person. It's almost impossible to do it yourself. And most of these deals have, several GPs, on the documents. It's not just one person. And so that's why, when we talk about like the metrics, right? Unit count, 693 units, value $90 million. Some of that is vanity metrics, and I will readily admit that, because, when you're that single family operator, you probably own that, single family home by yourself, right? Maybe a spouse, or maybe you got a partner, but usually it's one person. But when you have these large deals that are 10, 20, 30 million dollars, you're okay with having a small slice of that very big pie. And I think that's just something that people need to understand too. Like, if I have 693 units, I don't own 100% of those units. I own a very, very small slice of each of those properties based on, the work that I'm doing, that my equity slice in it. Of course, the investors own the predominance of it, right? So again, I just wanted to make sure the listeners have this perspective about it and be aware of that mind shift that has to take place when you go from the single family side to being one of many on the commercial side. You have to share that load. You can't hold it all yourself.
Well, and especially if you're a GP, you want several partners that are part of that deal. And I'll tell you why. A couple things. One is, exactly the metrics that you mentioned, right? Like you can own, 5% of $400 million, right? And that's a big deal, right? And so you're only owning a little slice, but that's a huge deal when you're looking at across this whole portfolio. Versus, I think Jay-Z was the one that came up with a quote, you can own 100% of something, but you can own 100% of nothing, right? You can own 100% of nothing, or you can own 5% of something that's much larger. So don't get discouraged on percentages, right? Because you can own a small piece of something big, and that equates to more than enough for your family, for example. So that's one thing. And on the GP side, when we have several sponsors, right? When we have, let's say, 4 sponsors or 5 sponsors doing something to manage a property, guess what? Then that means you're only doing 20% of the work, right? Because the sweat equity that goes to managing these properties, it doesn't all fall on you. And so, many folks that have owned single family or owned a duplex and they did everything themselves, they know yes, you own all of it, but guess what? You're doing, the buck stops with you, but so does everything else, right? You're getting the calls, you're doing all the work, right? Getting that property to where it needs to be. Whereas when we have several sponsors, we all have our roles and we're all doing a different piece of the whole mechanism, the whole business, keeping everything afloat. So you're actually doing less percentage work, but you own a substantial, a percentage of something substantially bigger than, say, a property that you can handle on your own. So that was a mind shift that I needed as well, right? Because we went from 16 units to 50 units. And then, 2 things happen. One, your own capital hits the ceiling, right? You can't really go bigger. And then secondly is your time. You only have enough, this much time to give. And so, when we went from that, started syndication, we're at, 3,000 plus doors now. The only way that happens is partnerships and, owning smaller percentages of bigger deals. So that's been a great, and that's something that's scalable versus, if you're doing everything yourself, again, you're limited by your own time and you're limited by your own resources. So you can't really grow that quickly. Versus with syndication, we are all able to grow very, very quickly.
Yeah, absolutely.
So, you've been investing since 2014, right? And so you've seen your share of kind of markets going up and down, and you've been, primarily in Tampa, but you've looked at, I'm assuming, other geographic markets. So talk about how certain market changes and things that are happening today, for example, how do those impact what you're doing and how you're doing, your investing?
Yeah, and so it's really just a matter of staying on top of those changes. I mean, we're obviously seeing, large shifts in the market right now compared to where it was, say, a year ago, right? Like anyone, I hesitate to say anyone, but a lot of people were making a lot of money in multifamily, over the past couple of years, and all of a sudden it's gotten harder. It's gotten harder to find deals that make sense. There's a much greater delta between buyers and sellers right now, and so we're kind of going through this uncomfortable shift in the market. All of that, not attributed to, but part of it is the increase in rates. Right. And so, you're going from having very reasonable rates to upwards of 6, to 7%, which completely change the numbers. Just like if someone's buying their own house, right? If you double the rate of their mortgage, it's going to make a difference on their payment. And for us, that really hits the cash flow side of things. And so it has become much more difficult, especially to find anything that has decent cash flow. You still may find deals that have, decent IRR or equity multiple over a 5-year hold. But you need to have those conversations with investors to say, hey, if you're 100% reliant on cash flow, then maybe this deal isn't for you because it just doesn't have the cash flow needed to meet your investment requirements, right? And so that's where, not every deal is going to be right for every investor. And I think that's important to understand. And we just need to have those honest conversations with investors. They have different needs. And so I think right now what we're seeing is just more deals that are low on the cash flow side, but maybe are still holding steady on like the equity multiple side of things, and we're just having to go through and underwrite a lot more deals and walk a lot more deals in order to find something that makes sense. And even then, when we get to the time where we're putting in our offer, our letter of intent, we may be $1 million off from what the broker is telling us the sale price is going to be. Now, I think sellers are starting to come around a little bit. What we're seeing is, they're starting to say, okay, the seller's willing to meet the market. And all that means is they're willing to drop their price to what everyone is telling them their property is worth now. So that's what we're really looking at. When it comes to, where we're investing, we really just look at the fundamentals. Now, population growth, job growth, and job diversity are my three biggest ones, because you don't want a market that's just going to crash if a major employer moves out. That's where the job diversity comes in. You need to have population growth, because people are tenants, and so as long as the amount of people coming in is still growing, then you presumably have a larger potential tenant base. So we're looking at that. I know rents are starting to lag, even go into the negative in some areas. I think that's primarily because they went up too much too fast in some areas. Phoenix and I don't know, Denver. I haven't looked at it lately, but some of those areas that just got really hot. And so what do you do when it's hot? You push rents up because people are willing to pay for it. So that's kind of pulling back right now. But if you look at areas like Atlanta, we're not really seeing that pullback as much as we were, as much as we are in some of our other markets like Tallahassee or even Dallas. Luckily, we're not going too far backwards, but again, you just have to readjust for future underwriting what that rent growth is going to be. We all talk about being conservative and not bumping it too high, but now we need to take into account what's happening over the past 6 months to say, okay, if this is the case, then what will that look like 6 months, 2 years, 4 years down the road? No one has a crystal ball, but we have to conservatively guess what will happen based on recent trends.
Yeah, and that's important, right? I think that word conservative. So this is what I think you mentioned it, right? 2-3 years ago, literally everybody and their mother that had any property, any multifamily property in any geography, they were making money, right? Valuations were going up, cap rates were staying low. There was a lot more deals out there, and just people operationally didn't need to do much to actually increase rents. That's the key, right? And so now what's hard is, we still have good properties, and obviously the debt has gone up, if you had an adjustable rate mortgage. So you have to squeeze a lot more out of each property. But if somebody did some good conservative underwriting on it and is a good operator, those things became very clear in the last year, right? Folks that were operationally really good, they could squeeze out more out of the property, squeeze the juice to get, that NOI, as much NOI as possible out of it. That showed a good operator versus, again, like 2-3 years ago, you didn't really need to do that. You didn't really need to look at expenses that drastically because your income was doing great. So, I think it shows a good operator, that manages to get us out of this current situation. Yes, your cash flow, like you said, cash flow is going to take a hit. You might see lower cash flow or maybe even no cash flow for a little while because we're holding, some operators are holding reserves in case, again, these rates keep going or whatever, right, for the additional stuff. And so holding back cash flow to be able to ride this out so that we come out whole on the other side. I think that, again, that's a sign of a good operator because they're anticipating conservatively what they're going to need to come out whole on the other side. So those are kind of some of the changes that we've seen in the last year or so that we're probably continuing to see, until we get to a place where there's a little bit more stability, a little bit more predictability, right, in the market.
Yeah, and you're absolutely right about operators having to dive more into the details, especially when it comes to their property management companies and the expenses that they're incurring there, and kind of holding their property management companies to task for some expenses that they may have just overlooked in the past because they weren't like a huge red flag. But now, you go from those huge red flags to, okay, well, this is more than we budgeted. Why?
Why?
Just asking that question, why? And a lot of them just, like you said, when you're comfortable, when you have plenty NOI, it's easy to not go into that level of detail. But I think a lot of operators, myself included, are getting forced to the position where we have to get down to the line by line detail.
Yep.
So that we can, get the cash flow that we need out of these properties. And that means, hey, do we really need all these people on site? Why was this advertising budget twice what it was last month? It may be okay, but I need you to explain it to me and how we're getting, the bang for the buck out of that.
Right. What's the ROI on each of these expenses? Right. Absolutely.
Yep.
No, this is great. So I know we're running on time here, so I do want to give you an opportunity to also, and if our listeners want to get in touch with you directly, how can they reach out to you? But before that, I do want to give just one question, I guess, because again, we talked about your journey and we talked about all the different things that you've done. If you could go back in time, give your younger self kind of a piece of advice, or something that could resonate with our listeners, somebody who's trying to get started and maybe looking at single family or duplexes, what kind of advice would you give them to start their own journey? Or what would you give your younger self a piece of advice, as you're embarking on your journey?
I guess, like I alluded to at the beginning, just get started sooner, because just from a purely wealth building perspective, no matter what you're investing in, the sooner you start, the better the results will be over time. So, for example, for myself, at 20 years old, when I first got out of the military, I wasn't thinking about investing in anything. In fact, I was going the opposite direction. I was blowing every dollar I had. I would smack myself and then tell myself, hey, what you should do is buy a property, whether it's a single family or a duplex, and where I was going to be going to school, which was Tallahassee, while I was still in the Army, like my last month, because then I could show proof of income and probably qualify for it. And then that way I would have started the process of building equity at a very young age. And a lot of military folks and veterans don't know that you can buy multifamily properties using your VA loan. You can, as long as you're living in it.
Living in one of the units, yeah.
Right, that first year. So I could have bought a duplex, lived in one side, rented out the other, and probably, paid the full mortgage based on that at the time. And it would have set myself up huge for the future. Unfortunately, I wasn't that smart back then. But, if I had to do it over again, like you said, that's what I would have done. That's
great. That's great advice. I think, folks that want to be active and sort of like getting that experience of like, renting a unit. One of the things that we do is do that, like, a duplex or a fourplex where you're living in one of them, and then, your close proximity. So there's ease of management as well. And so that's huge from lending advantages, from, proximity, from your first foray into landlord and ownership. That's a great way to get started. Absolutely. That's great. So Tim, before we sign off here, if our listeners want to connect with you directly, what's the best way to connect with you?
Sure. They can reach me directly at tim@zanainvestments.com. Go to my website, which is zanainvestments.com. I'm also very active on LinkedIn, so I encourage everyone to, connect, follow with me on LinkedIn. And I'm on the other socials as well if you look up ZANA Investments. Also have a podcast if people are into that, which I'm assuming they are if they're listening to your show. So it's called The Journey to Multifamily Millions. So you can find that on any of the podcast platforms. And finally, I would just like to offer your listeners the Passive Investor Cheat Sheet, which is basically like the top 33 terms that they need to know to confidently get started passively investing. I promise it's not super boring. It's written in plain English by myself with examples, so that it's really easy to understand for someone who's getting started. And they can get that at zanainvestments.com/cheat sheet.
Excellent. Thank you, Tim. Well, it's all the time we have for today. Tim, I really want to thank you for being on our podcast. Thank you for sharing your story. I know that with sharing your journey is truly going to be inspiring some of our listeners out there. And so, again, thank you for sharing that, and also congratulations on all your success. And wish you plenty more success in your journey.
Thanks, Param. It was great being here.
And for our listeners, thank you for tuning in to this episode of the Spur Your Wealth podcast. Again, I'm your host, Budham Singh with Spur Equity. Remember, your journey to financial freedom begins with knowledge and action, where knowledge is power, but action is a superpower. Until next time, happy investing.
Thank you for joining us on this episode of Spur Your Wealth podcast. We hope you enjoyed the valuable insights and inspiration. Don't forget to subscribe to our podcast and stay updated on future episodes filled with actionable tips and strategies.
If you want more information about our investment projects, visit us at SpurEquity.com. If you have an inspiring story to share and would like to be a guest on our podcast, email us at podcast@SpurEquity.com. Until next time, happy investing.